Welcome back. We've just gone through an analysis report titled VVPR Stock Explodes, plus 22% in one day. Is this the next big squeeze?
Mm-hmm.
So the core idea here seems to be that Vivo Power, or VVPR, could see a massive short squeeze, all driven by this new $300 million joint venture to get Ripple Labs shares.
It's a really compelling read. It absolutely nails the excitement in the market right now.
It does, but to make it truly rigorous, to make it persuasive, I think we need to apply a bit more scrutiny to some of the financial claims under the hood.
I agree. It establishes that emotional hook perfectly. You see the name Ripple and you're in.
Right.
But when you start to dissect the architecture supporting that valuation spike, there's a real chance here to turn a good narrative into a much more robust financial thesis.
Okay, so let's dive right into that. Critique number one. The Ripple deal is clearly the catalyst.
It is. The material effectively identifies the Ripple deal as the primary catalyst, but it needs to substantially bolster the logical connection between the deal mechanics and the equity valuation lift for VPVR.
Okay, break that down.
So the core argument is sound. Vivo Power sets up a joint venture to go acquire $300 million of Ripple shares.
And in return, they secure $75 million in fees over 3 years. For a $40 million microcap, that number's huge.
It sounds transformative, right? But the analysis also correctly points out a key detail. VVPR isn't using its own cash.
Which the report frames as a strength. It mitigates risk because they have so little cash on hand.
And that's precisely where the thesis needs to be strengthened. That lack of internal capital exposure, it's a double-edged sword. Yes, it protects them from cash burn, but it also weakens the argument for an immediate fundamental valuation spike.
Because if they're not risking their own capital, they aren't actually acquiring a massive asset on day one.
Exactly. The spike is fueled entirely by the future expectation of fees, and that introduces risk. It introduces uncertainty about timing.
So the weakness isn't the deal itself. It's the leap of faith from we're going to get fee revenue someday to our equity is worth massively more right now.
Precisely. So the suggestion is to reframe the bull case. You need to clearly articulate how that fee structure directly and financially impacts current shareholder equity. Move beyond the hype.
Okay, so how do you do that? How do we make that $75 million number feel more concrete for a shareholder today?
You have to focus on profitability and per-share impact. The analysis correctly notes the company's huge net losses. What was it, negative $12 million?
Yeah, negative $12 million. It's ugly.
So first step, detail the expected net profit margin on that $75 million in fees. Then project the expected per-share increase in tangible book value over, say, the next 12 to 18 months.
Why is the per-share tangible book value so much more important here than just the raw $75 million?
Because investors trade shares, not total revenue. By calculating the per-share impact, you take this big, abstract number and you turn it into something tangible. It's measurable leverage for a shareholder.
It proves the fees aren't just going to plug a hole in the balance sheet.
It proves they are fundamentally changing the value of each share. That's a much more powerful argument.
So you're basically providing a roadmap for when the company flips from burning cash to actually accumulating shareholder value.
That's it. You have to compare that $75 million directly against the net losses and explicitly show when VVPR is projected to hit profitability because of this deal.
Not just that they're getting fees.
Right. Show the quarter they might go cash flow positive, or alternatively, the report mentions the South Korea connection, which is a huge market for XRP. Elaborate on that. Is this a one-off deal, or could this be a template for future JVs? That changes the story from a single transaction to a whole new scalable business model.
And that gives the growth story much more long-term credibility. Okay, that's a great point. It's trading some of that high emotion for hard, defensible math.
Yes.
So, if the fundamentals, even when we strengthen them, only support a fraction of the current stock move, that means the rest is purely technical, the squeeze. How do we tighten up that narrative?
We move to the technicals. And the analysis is great at identifying the setup. Tiny market cap, very low float.
Right, about 7.6 million shares.
And the velocity squeeze argument that when volume explodes, it causes these instant moves is spot on. But while the material correctly identifies the conditions of low float and explosive volume, the short interest data it presents is, well, it's just not compelling enough to support the next big squeeze.
Wait, hold on. The short interest is 8% of the float. With volume already exceeding the float on December 16th, isn't that low liquidity enough to justify calling it a big squeeze?
It's enough for a big move. But a massive squeeze? 8%, even for a microcap, isn't what you typically call GameStop levels of pressure.
I see.
The analysis is relying too much on the fact that it's a volatile microcap. If we're promising the next big squeeze, we need evidence that short sellers are actually trapped, not just inconvenienced.
So the static percentage doesn't really capture the urgency. It doesn't tell you if the shorts are doomed.
Exactly. So the suggestion is to bring in more dynamic, more actionable short interest metrics. We need to quantify the gridlock for the shorts.
Okay, so what's the most effective metric for that? What really shows that pressure?
Days to cover, DTC. It's the single most dramatic indicator of real short pressure.
And that's short interest divided by average daily volume, right?
Right. It mathematically shows how many days it would take for all the shorts to buy back their shares and close their positions. If that number is high, say 3 or 4 days, it signals a traffic jam, an explosive queue when buying starts.
And why is that so powerful?
Because it quantifies the constraint. It means shorts are mathematically forced to compete against each other for a limited supply of shares over several days. That forced competition is the definition of a squeeze.
So adding that one metric would instantly give the whole thesis more weight.
Far more weight than just citing a low 8% short interest.
That's a fantastic way to quantify it. Are there any other metrics that could show that real-time pressure?
Yes, absolutely. If possible, the analysis should try to find the current borrow fees for VVPR shares.
The interest rates for shorting?
Exactly. High borrowing costs are an immediate, real-time signal. It's much faster than the delayed regulatory data. It tells you right now that the supply of shares to short is tight and it's getting expensive.
Which forces shorts to cover faster to avoid those costs.
It forces their hand. And finally, on that volume spike,
Yeah, it just says the volume exploded.
we need to quantify it. Compare the December 16 volume to the 90-day average. Stating, for example, the volume was 20 times the 90-day average provides hard data. It's much more effective than just descriptive language.
It grounds the momentum in overwhelming technical pressure. Got it. Okay, those suggestions really move the technical analysis from good to genuinely robust.
Right.
So now let's pivot to the overall structure, specifically how risk is handled. The analysis is clearly going for a high-octane feel. If we weave the risk in so heavily, aren't we kind of muting the excitement they were aiming for?
That's the central challenge, isn't it? And to be fair, I really appreciated that the report included a bear case section. It acknowledges the ugly financials, the minimal revenue, that $12 million net loss. It even correctly summarizes it as a story stock.
So the honesty is there, but I do wonder about the placement. It's in a separate section after all the exciting price targets, like the $5.10 analyst target.
And that structural isolation is the weakness. It feels like an afterthought. It risks minimizing the impact of these really severe fundamental issues.
Especially for a momentum trader who might just scan for the target price.
Exactly. You can't make them feel tricked later if the stock reverses. You have to respect their risk appetite by putting the risk up front, right alongside the opportunity.
So you're saying we have to weave the caution directly into the bullish arguments.
Yes, the suggestion is to restructure the analysis so that the financial risks, the story stock status, serve as mandatory qualifiers when you're discussing any potential returns or key breakout levels.
This makes the whole thing feel more like a balanced intellectual argument and less like a sales pitch.
You're demanding the reader confront the risk every single time they look at the reward.
Okay, give me a concrete example. Let's take the key resistance level mentioned in the analysis.
All right. When discussing that resistance level around 330 to 350, you immediately add a qualifier. Something like, given the company's significant financial instability and that $12 million net loss, breaking this resistance requires sustained volume that confirms institutional belief that the ripple fees will definitively overcome the core business weakness.
So you're contextualizing the technical barrier within the fundamental struggle. You're telling the reader exactly what that volume needs to prove.
Precisely. And you do the same thing for the support levels.
Okay, so how do we tie the risk into the stop losses?
You tie it directly to the risk assessment. You could say, the breakout support at 265 is crucial, as a fall below the 250 stop-loss territory would signal the market is reverting to valuing the company based on its weak fundamentals, the cash crunch, and not the future ripple narrative.
That's so much more powerful. It shows the reader why that stop-loss matters. It's not just a line on a chart. It's the point where the entire story fundamentally fails.
An evaluation reset happens.
I think this holistic integration is it's crucial for the intellectual honesty of the analysis.
Absolutely. And in the final verdict, you have to frame it explicitly as a high-octane speculative play within the context of capital preservation. You have to acknowledge that if that ripple deal gets delayed, the momentum is gone. Instantly.
because the core business can't support the price. Okay, this has been a tremendous